All right, let's dive right into this explainer. Look, if you're a business owner, whether you're running a highly seasonal operation, managing a bustling restaurant, or even running a heavy-duty truck fleet, you absolutely know the universal struggle. We're talking about managing those massive upfront capital costs of scaling your operations, all while trying to keep your daily cash flow healthy. It really all boils down to one massive question that pretty much every Canadian entrepreneur has to face at some point. Should you use your hard-earned capital to buy equipment outright, or should you lease it? It's kind of a high-stakes juggling act, involving tax liabilities, working capital, and long-term equity. And honestly, getting this wrong, it can severely impact your business's survival. So here's our roadmap for exactly how we're going to break this decision down today. We'll cover 1. The cash flow dilemma. 2. Buying and Canadian taxes. 3. The case for leasing. 4. The hybrid equipment strategy. And 5. Unbundling heavy equipment leases. Let's just jump right in. Part 1. The cash flow dilemma. You know, when you're navigating the extreme peaks and valleys of seasonal revenue, preserving your working capital isn't just nice to have, it's absolutely critical so you don't run dry during the off-season. QuickBooks actually highlights 5 vital survival tactics for this. You've got things like using contract employees, looking for flexible locations, utilizing low-interest borrowing, and minimizing your working capital requirements. But the one we really need to focus on is leasing equipment. Instead of tying up your cash in these massive upfront purchases, employing strategies like seasonal skip payment leases, where you literally only pay during your busy season and pause payments when things are slow, is an absolute lifesaver. All right, moving on to Section 2, buying and Canadian taxes. Now, when you buy equipment outright in Canada, it's considered a capital expense, or CapEx. You can't just take that receipt and deduct the entire cost from your taxes in year one. No way. Instead, you're bound by the CRA's Capital Cost Allowance, or CCA. Basically, CCA is the tax rule that dictates how Canadian businesses claim depreciation to calculate their taxable income. To put it simply, CapEx means slow, drawn-out tax write-offs over many, many years. Buying essentially locks your assets into these rigid depreciation cages. For example, Class 8 covers miscellaneous furniture at a sluggish 20% depreciation. Class 10, which is for tech and vehicles, and Class 43 for machinery, both sit at 30%. Oh, and then you have to add in the CRA's infamous half-year rule for year one, which instantly slices your initial tax shield in half. So yeah, you build equity, for sure, but your working capital is depleted immediately. Which brings us nicely to Section 3, the case for leasing. Let's put these two paradigms head-to-head. On the one side, buying, or CapEx, builds equity, yes, but it depletes your working capital and saddles you with that incredibly slow CCA depreciation we just talked about. On the flip side, leasing, which is an operating expense, or OPEX, preserves your cash, doesn't tie up your equity, and typically those lease payments are 100% tax deductible each year. You are essentially turning a massive, intimidating upfront hurdle into a completely manageable, fully deductible monthly operating expense. And here is a hidden benefit that, honestly, almost everyone completely misses. Leasing acts as this built-in inflation hedge. Think about it. You lock in today's equipment price right now, but you pay it off over the next 3 to 5 years using future dollars. And thanks to inflation, those future dollars are actually worth less. So beyond just making your startup credit approvals way easier, leasing is a brilliant way to literally let inflation work for your business. Okay, Section 4, the hybrid equipment strategy. The smartest, most profitable chains out there, they don't just blindly choose one method for everything. Instead, they use this brilliant framework called passive iron versus revenue iron. Passive iron refers to your durable, but let's face it, dead assets. Think stainless steel prep tables, sinks, standard shelving. These things might last 20 years, but they don't generate any direct profit to offset a lease payment. So you should buy those with cash. Revenue iron, on the other hand, are your profit engines. We're talking about a high-end Taylor soft-serve machine or a specialty fryer. These actively generate revenue day in and day out, and these are the exact assets you should always lease. Just think about this quote for a second. Why tie up $25,000 of your own cash when the machine can pay for itself? This is exactly the mindset shift you need. High-margin items can generate so much revenue that they literally cover their entire monthly lease payment in just the first 3 days of the month. That leaves you with 27 days of pure, unencumbered profit, all without ever having to drain your emergency funds to buy the machine in the first place. It's a total game changer. Let's actually put some tangible numbers to this to really ground the math. Imagine acquiring a $15,000 oven on a 5-year term.
If you buy it with cash, your upfront cost is 15 grand, your total cost is 15 grand, but boom, you have zero cash left. Now, if you lease it, your upfront cost might just be the first and last month's payment, let's say around $600. Now, yes, the total cost over 5 years is absolutely going to be higher because of interest, probably between $21,000 and $24,000. But look at that bottom line. You retain over $14,400 in vital liquidity on day one. For a growing business, keeping that cash sitting safely in your bank account is almost always worth the extra long-term cost. Now for Section 5. Unbundling heavy equipment leases. If you're dealing with massive assets like transport trucks, listen closely, because not all leases are created equal. A full-service lease, or FSL, essentially bundles all your costs together. It offers zero transparency, and you basically surrender all of your maintenance and fuel decisions to the provider. Contrast that with an unbundled lease. This method separates all the costs out, giving you complete clarity, flexible scaling for your fleet, and most importantly, absolute control over your maintenance choices. The financial difference between these two approaches is staggering. Industry data actually shows that fleets can save between 15% and 25% in operating cash simply by separating a full-service lease into an unbundled agreement. It really begs the question, why on earth would you give away cash that you are never going to get back just because of a bundled contract? Well, here's the dirty little secret. Full-service leases quietly front-load your maintenance costs. They might charge you a minimum of 7 cents per mile for maintenance in year one, which makes 0 cents because a brand new truck is fully covered under warranty. But with an unbundled lease, you pay the true cost, which is much closer to the national average of just 2 cents per mile. Unbundling basically gives you the freedom to scale, upgrade, and stop overpaying for things you don't need. So let's tie all of this together into a real game plan for any business owner staring down a massive equipment acquisition. Step 1, categorize the asset right away. Is it passive iron or revenue iron? Step 2, if you are buying, double-check those specific CCA tax classes so you know exactly what your depreciation timeline is going to look like. Step 3, compare those painfully slow CapEx write-offs against the immediate OpEx cash flow benefits you get from leasing. And finally, Step 4, if you're leasing heavy equipment, always demand unbundled lease terms so you maintain maximum transparency and control. I want to leave you with a provocative question to really challenge how you look at your balance sheet today. Is your capital trapped in dead assets, or is it actively working to fuel your growth? Make sure you're leveraging your cash flow strategically and let those profit engines pay for themselves. Thank you so much for joining us for this explainer, and we'll see you next time.